Good afternoon, everyone, and thank you so much for joining us for today's Zoom webinar. My name is Migdalia Gomez. I'm the AVP of Community Engagement, and I'm here to really moderate today's presentation, which will be led by one of our MLOs, Ryan Douglas. But before we get started, I want to tell you a little bit about us and what we do at the credit union, and specifically our Thrive Financial Wellness program. So through Thrive Financial Wellness, this is free personal finance education for you and anyone in your household, anyone in the community. At the credit union, as a not-for-profit financial institution, we're very fortunate because we're able to give back our profit in many ways, including free financial education through a variety of different ways. We do presentations, we have free financial counseling available, also have online learning portals, all available to you at hbcu.org/thrive. So I welcome you to get familiar with those resources and know that they're available to you at any point. So a little bit of housekeeping for today's presentation. I'm sure most of you are familiar with Zoom at this point. We've been using it for so long, for some of us even before COVID. Now, we did go ahead, you're on a webinar, so everyone is able to, if you're having lunch right now, or if you have a child or a dog in the background, that is okay. We will not hear it. However, this is all about you, and we still want it to be engaging. We still want to make sure that we can communicate with you. So if you do have any questions, please use the Q&A. We're not going to use the chat. We're going to use the Q&A today. The chat is great. I love it. It's just a little bit harder, and we don't want to miss any questions. With the Q&A, we can clearly see if we missed any questions. And just to make sure that it's working, if you could let us know, where are you joining us from today in the Q&A? It could be the city, it could be your office location, if you're in the hospital, just let us know, where are you joining us from today? And that is using the Q&A feature. Wonderful. I see someone's joining from Milford. Thank you. I see someone that's joining from the South Shore. Have someone in Longwood. Appreciate that. Someone's joining from home. Thank you so much for sharing. Perfect. Thank you so much, everyone, for sharing. And just like you let us know where you're joining us from, any questions you have, please let us know throughout today's presentation. We're here for you. So the point of today is to answer any questions that you may have. And if we didn't do that, we didn't do our job. So we want to make sure that you use that Q&A and we get those questions answered. We are recording today's webinar. It will be available on the YouTube channel that is dedicated for DFCI presentations, and we will email you all of that most likely by the end of the week, hopefully a little bit sooner, but probably in the next day or two, we'll be able to get that over to you. And we'll also at the end have a quick survey so that we can get any feedback and make sure that we can improve our presentations for you. Now, for those that may not be familiar with us at the credit union, we are Harvard's not-for-profit financial institution. So what does that mean? Essentially, we're the same as a bank in the sense that we have the same products and services. We have checking accounts, student loans, mortgages, boat loans, RV loans, credit cards, you name it, we have it. The biggest difference is that as a not-for-profit financial institution, we're able to give back our profit in the form of lower rates on loans, higher rates on savings, and then a lot of community service events that we are able to host, and a lot of focus on personal finance education. And once you're a member of the credit union, you're a member for life, even if you're no longer employed by DFCI or any other Harvard affiliated employer. Once you're a member for life. And once you're a member, anyone in your family, including parents, children, grandparents, siblings, can all be members as well. That's all that I will say specifically about the credit union, but if you do have any questions, you're more than welcome to visit us on our website, hbcu.org, and we will be having a new branch that's opening in the fall over at the Longwood Medical area, across from the Galleria, right near, trying to think, near Sweet Greens too. So if you like Sweet Greens, we'll be right on that block on the other side. And with that, I'm going to turn it over to Ryan Douglas, who is one of our mortgage loan originator, and he will be going through today's presentation. And I'll be taking myself off video and turning it over to you, Ryan.
Thanks, Migdalia. Hi, everybody. Thank you very much for joining me today. My name is Ryan Douglas. I work out of the MGH branch. I serve all of the other branches, though, mainly Assembly Row and Charlestown. But I'm excited to have you here today, and let's get into it. So for today's agenda, we're going to go over options for once you own your own home. We're going to go over refinancing. We're going to go over home equity lines of credit and the next steps, taking you to the next steps into saving money. I'm just going to shut my video off here so we can go over everything. And thank you very much, Migdalia. So you own your own home, Now what? So there's several options you can do as a homeowner. You could take no action. You can leave your mortgage the way it is. You could accelerate the payment to pay it off sooner. You could borrow against the equity through a home equity line of credit or a fixed second rate mortgage, or you could change the terms of the loan through a refinance. You could also do a reverse mortgage. So there are several options out there for you to take advantage of as a homeowner. So we're going to jump into refinancing. So what is refinancing? A mortgage refinance is when you replace your current mortgage with a new loan. Ideally, that new loan will be more beneficial to you as a borrower. Now, common reasons to refinance your home mortgage. You can reduce your monthly payment, reduce or extend the term of the loan, to reduce both the term and the payment, to borrow additional funds to pay for major expenses, or to remove your private mortgage insurance. At HUECU, we do offer 3 options for refinancing. So we do have a cash out refinance. This would be a refinance for when you own your home outright, and you could tap into that equity that you've built into your home through a new first mortgage. We have rate and term refinances, which you'd keep your current loan amount the same, but you would lock into a new rate and term. And again, ideally more beneficial to you as a borrower to reduce the monthly payments. And then we also offer both cash out and rate and term refinances, which you would do both of those options simultaneously by taking out a larger loan. You would take your current mortgage loan amount, and then you would also be able to tap into that equity into a larger loan balance. So cash out refinance. So for cash out refinance, several reasons why borrowers are going to borrow against their home equity through a cash out refinance. For home improvements, such as the picture on the right here, you can do a kitchen remodel. You can access that capital at a lower interest rate there, so you can get your projects done around the house. Life events come up where you're going to need you might need large amounts of funding to pay them off for a wedding or medical expenses, rainy day funds. There's tax considerations as well. You could also tap into that equity to purchase a second home. So the benefits are out there for having the equity built into your property. So in order to determine the home equity available to borrow, we're going to require an appraisal to take place. And then typically lenders are going to use 80% of that appraised value from that appraisal that will take place. And then from that 80% value, we are going to deduct any current mortgage balances that you have on the property. So if you note on the right-hand side here, here's an example for a home that appraised at $650,000. With that, the adjusted appraised value would be $520,000. That's being 80% of the $650,000 value, less the current mortgage balances of $275,000. Your available equity to borrow against would be $245,000 in that property. So another option, rate and term refinances. So the biggest benefit to a rate and term refinance is the potential interest savings. By locking into that lower interest rate, you could reduce your monthly payment while keeping the same amount of term, and it's going to save you. Your monthly payments are going to be much lower, and it's going to save you a significant amount of interest over the term of the loan. So should you refinance? There's a few things to consider when you are making a decision whether or not to refinance. You want to compare your new payment versus your existing payment. Also associated with refinances, there are going to be closing costs involved. So you do want to factor in those closing costs into your decision. If you note on the right-hand side, this is just an example. Every property will be specific, depending on the closing costs. So with an upfront lender fee of $2,500, your annual savings could potentially be $960. So that's saved by having the lower interest rate. And then with that, in 2.6 years would be your break-even point, where you start to kind of see that total monthly cost savings for having that lower monthly payment. So it's something to factor in. Definitely discuss with one of our loan originators for where your break-even point would be there, and any other questions you have as well. In addition to discussing with one of our loan originators at the credit union, we also have some great resources available on our website. If you go to HUECU/calculators, you can go in there. There's a refinance calculator that really help you make a decision for, making the right choice for you as the borrower. So should you reduce or increase the term for your refinance? A couple things to consider with this. If you were to reduce the terms for your refinance, this may greatly reduce the total interest paid over the term of the loan by having that lower monthly payment, of course. Also, by reducing the term, you're going to build the equity more rapidly because you'll be paying more towards the principal rather than the interest with the shorter term. Typically, you can obtain the lower rate for the shorter term. That's pretty standard. And it could align better with your financial goals. The goal to get into financial freedom by paying off your, all your debts or your mortgage, you'd be paying that off that much faster. On the other hand, when considering to increase the term, this may increase your monthly cash flow due to the lower monthly payment, as you'll be spreading out that mortgage payment over a longer period of time. Your monthly costs will go down. So in addition to refinances, we also offer some second mortgage products. We have Helocs and fixed rate second mortgages, which we'll go over next. So Helocs and fixed rate second mortgages, a few different benefits compared to these differences are going to be that a refinance is not required of your first mortgage, and there's no upfront fees for HUECU borrowers. Please note with these, there will be an appraisal fee involved if you are taking out a second mortgage or a second product of $250,000 or greater. So the first one we'll go over is so what is a Heloc? It's a home equity line of credit. So it's a line of revolving credit secured by your home. Typically, it's going to be variable rates. At the credit union, we currently calculate our rate. It's going to be on the advertised prime rate by the Wall Street Journal minus a discount of 0.26%. That's how we calculate it. We are running a promotional rate right now, 2.99 for the first 12 months. And then following that, you would switch to that variable rate on each bill cycle. You can use a Heloc for several things, just like a cash out refinance or a refinance. You can use it to pay for large or small expenses, and it's going to function similar to that of a credit card. There are advantages involved with the Heloc as well. It's generally going to be a lower rate than common loans. So, if you are looking for a loan amount, it's going to be, a lot lower than a personal loan or credit card, of course. And then the interest may also be tax deductible. One disadvantage, just to note up the front, again, with the variable rate, should the prime rate be increasing, your monthly payment is going to increase as well. So how does a Heloc work? There's a borrow period. So it's normally going to be the first 10 years where the funds are going to be, the funds that are closing that were established, they're going to be accessible to you to draw upon. You can use that for any expenses, that are going to be used for. And then as you repay, the credit is going to be refreshed. So it is going to replenish that credit line. It will be available to you for that first 10 years. And then the repayment period will begin following that draw period of the 10 years. So for the first 10 years, you're going to be responsible for interest-only payments. You're welcome to make principal payments as well. But following that 10-year, the repayment period will begin where you'll be paying your principal and interest back on that loan amount. And then our other mortgage product, second mortgage product that we offer is a fixed rate second mortgage. So this allows you to borrow the full amount at closing at a fixed rate and term. So this won't be a variable rate. You'd be locking into a rate and term. The credit union offers all different options on this. We have ranging from a 5-year fixed rate second mortgage all the way up to a 20-year fixed rate second mortgages. Typically with this, the shorter the term on the fixed rate, the lower the rate you'll receive. An advantage, borrowers, they do like the peace of mind knowing that the payment will not increase without the variable rate associated with these products. The disadvantage is there's no flexibility to repeatedly borrow against the credit line. So you're not going to refresh that credit each time you make a payment. It's just going to be paying off the principal and interest with the loan. So we have 5 MLOs that work at the credit union. We're more than happy to assist you with any questions, not just for refinances, anything that you do have. We work across, the Harvard community. Please feel free to reach out to us. You can schedule with us on our website. Our emails are listed here, but we'd be more than happy to assist you with any specific questions that you might have. And to view our products and services at the credit union, you would just have to go to HUECU/home loans. On there, you can check out all our different products, the specifics that are going to be associated with them, any type of cost. But again, please give us a call and we'll walk you through it for anything that you have a question on.
Thanks so much, Ryan. I know we have a couple of, we wanted to keep this webinar a little bit shorter because we usually get a lot of good questions. So thank you, Ryan, for doing
Sure.
such a good overview. And we did start getting a couple of questions in, but I want to remind folks, if you do have any additional questions, you can actually go on just the same way you let us know where you're joining us from. Use the Q&A to let us know any additional questions that you may have. As Ryan is answering these questions, I will put a link to our survey just so that you can let us know how we can improve, what other topics you would like. We review these with your colleagues over at DFCI to make sure we're bringing you the information that you want to hear. And one of the questions that came in, Ryan, was if mortgage is under 2 people, does the refi need to be under 2 people?
Not necessarily. So it is something that we do see, frequently. There's all different, circumstances here. So it would be depending on what's going on, if you're taking somebody off the mortgage or if you're just trying to qualify a loan, it's not necessary. We can review that for you. Absolutely.
Thank you. Another question, which is, I feel like this question's about student loans. It doesn't matter what presentation we're giving, it comes up. But
It's a hot
how do
topic.
exactly? How do student loans factor?
So the student loans currently, we do factor those into your monthly debt obligations, of course. So currently, without the repay with the sorry, that slipped my mind. Without the repayment being required at the moment through the government, we are going to factor in 1% of your current mortgage, 1% of your student loan payment into your monthly debt obligation. So we will have to, so please be aware that we will be using a payment even if you are required to be paying 0 when we do factor these into your calculations.
Thank you, Ryan. And I just want to do a quick moment to just, we do have a disclaimer on screen. Everything Ryan is providing is general information. As he said, please visit our website or come into the branch and contact one of our MLOs if you want specific information with your situation. But everything we've said it has to be general information since we don't know your particular situation. And then another question that came in, are the closing costs the same as when you purchase the house?
Yes, they're going to be very similar to those. Just you could expect to be spending it's going to be the same cost associated with purchasing your home.
Thank you. Another question that came in, are there minimum credit requirements for Heloc applications?
Yes. So currently we have to have the borrowers have to have 620 credit score or higher. And that goes for all of our mortgage products as well.
Thank you. And I know, Ryan, if you can maybe speak to it a little bit, I know that a good amount of you usually work with folks. So if they don't have that credit, I know there's Green Path, but can you speak a little bit to what options are available if someone doesn't meet that credit score?
Yeah, I mean, so that one of the good things is, that's kind of our guideline there on the 620 credit score, but we do offer some great products, like you said, at the credit union, Green Path Financial Wellness that can help you kind of get your credit in order there. Then we can, and then you can come back and reapply and we can assist you with it once we get everything figured out.
Thank you. And someone asked, how long after you have your home can you refinance?
There's no requirement on that, so you're welcome to do so at any point. Again, you just want to, if you want to go back to the slides there, you just kind of want to, factor in all the considerations here, closing costs and everything.
Another question regarding student loans, as you said, a very hot topic. Do you recommend Heloc to pay off my own student debt?
It's an option available to you, absolutely. But just please do keep in mind with making that decision, it is a variable rate mortgage product. So, I would just try to, when you compare the two, you want to make sure, your monthly payments are going to be, it's going to be more beneficial to you as the borrower.
Yeah, and I'll definitely add in a couple of things given some of the other presentations that I've given in my experience with working in financial aid in the past. With student loans, especially if you have federal student loans, we don't recommend right now refinancing those federal student loans or paying them off with another loan, because with a federal student loan, as we know, the rates are at 0% currently. You don't have to make payment. And there's also a lot of talk as to what may potentially happen. If as DFCI employees working at a hospital, you may be eligible to have your loans forgiven. So if you haven't looked into that, I would check. We have a couple of webinars on our YouTube channel, which is youtube.com/myhbcu to learn more about public service loan forgiveness, but also just with federal loans, there are a lot of benefits that are associated with those federal loans that you won't have if you pay off the loan. So, if in the future you can have an amount forgiven, or maybe you are thinking about going back to school, there are just some benefits that we highly encourage you to take a look at before considering refinancing. As for private student loans, it may make sense, it may not. There also are tax considerations with student loans. You do have, depending on your modified adjusted gross income, you do have a certain amount that up to $2,500 in interest that can be written off for your student loans, that if it's no longer student loans, that won't qualify. So highly encourage you to do a little bit more information. And for the public service loan forgiveness, you can watch our YouTube channel and also even check with the HR office at DFCI, because I guarantee you that someone in that office or your local HR representative is completing the employee certification forms. So that's a really good place to start. Not sure if there was anything else that you maybe wanted to add about student loans or anything else in general. I don't see any other questions, so I'll sort of see if there's anything else that you want to add, Ryan.
On the student loans, no, I think you nailed it. Thank you very much. But again, please reach out to us with any specific questions you have. We're happy to help. We're here for you. So thank you for joining us today.
Thank you, everyone. And as I said, you'll probably get the recording in about a couple of days, maybe a day or two. But thank you, everyone, for joining. And if you do have any additional questions, you can reach out to Ryan or any of our mortgage loan originators at hbcu.org/home-loans. Hope everyone has a wonderful afternoon. Thank you.
Thank you.